Welcome back to Turpentine VC, the podcast where we discuss the art and science of building successful venture firms, VC to VC. Today, we're airing another popular episode from 2023 where Hemant Taneja, the CEO of General Catalyst, talks about the shift from artisanal business to an enduring firm. Up ahead, Hemant talks about the process of establishing operational rigor internally, General Catalyst's approach to fund size, talent strategy, and their early bets in companies like Stripe, Gusto, Snap, and more. Let's dive in. Hemant, welcome to Turpentine VC. Thanks so much for coming on the podcast.
Thanks for having me, Eric. Excited to do this.
When you took over as CEO at General Catalyst, was there a CEO prior? Or talk about how that development happened.
Look, it was really interesting. Our desire to build an enduring firm and an enduring business really started, I would say, middle part of the last decade. I remember this amazing meeting I had with David, Jewel, Bill Fitzgerald, who was our CEO and really one of the co-founders from the beginning, and we were discussing the future of what we're going to do with General Catalyst. And I don't take this as hubris. I said, look, you don't realize this. Certainly the world doesn't either, but I think I will end up doing reasonably well. I by then invested in Stripe and Snap, and we started Livongo and Gusto, and I'm like, wow, these are amazing companies. I was just very hopeful that was going to work. And I said, I would like to build a platform, and this is a firm you guys started. I want to be respectful to what you want to do here. And to their credit, they were like, we absolutely want to build an enduring firm and leave a great legacy. And what do we need to do? And I think that's really when that journey started. And then, as you know, we brought in Ken Chenault as our chairman and managing director about 5 years ago now. And that was, a lot of people wondered, why would you bring somebody who was a Fortune 500 CEO into the venture business? Our intentionality very much was about how do we learn to be a good business? And I give, Ken a lot of credit, first of all, mentoring me and learning how to take charge. Because if you're going to scale, you need to get away from the traditional mindset that this is an artisanal business and it's a small partnership and we're sitting around the table and making these, decisions like oracles to, hey, we're going to build a business. And none of us knew how to build a business. That's the irony of our business, which is, we're not the best operators. And so it was a very intentional choice to bring Ken in to mentor me. So it was actually, even though we announced it last year, it was a 5-year journey. And I remember Ken sat us down at the very first dinner after he joined. And he said to David and Joel and me, he said, I know I'm here. I'm here to drive this succession. So this can be an enduring firm. And it's just been amazing to watch him, develop me and develop others in the firm and help us, navigate this succession as successfully as we have so far.
It's fascinating because investors, we as venture capitalists would never invest in a company that didn't have a CEO or that had, 5 CEOs sitting around the table and saying, hey, we got to vote on everything, et cetera. And yet so many venture firms operate that way. Talk a little bit about that.
So in 2012, I remember sitting down with one of our LPs at that time, and they saw that we're starting to think about perhaps scaling our business. And, I said to this particular LP that, hey, we are a business. And the LP said, you're not a business. It's a convenient arrangement for us to pay fees for you to manage our money. That really hurt, by the way. I was just like, that is literally how our industry gets thought of. And there was also this conventional wisdom that the more time you spend internally as a venture capital firm, the less time you spend with your founders and the less successful you will be. So the biggest irony of our business is we give great advice to other founders on how to scale their businesses, but we actually never run ours in a good way. And I was like, we have to change that. I mean, I said this. I was like, folks like John and Patrick at Stripe or Evan and Bobby at Snap. And I was watching, Josh and Eddie Tomer at Gus. I'm like, wow, they're these amazing operators. We need to run our business with the same rigor. We need to learn from them and actually bring that into our own organization. And that's the journey we've been on, since then, to say we need to operate with the same rigor as opposed to It's just a few of us, making a handful of investment decisions a year, and the rest of it doesn't matter.
Say more about the business that you're building. You already have a few different venture products, but we'll get into them. But say more about what's the vision for General Catalyst? Where is it 5 years from now, 10 years from now?
So one of the first things that Ken had us do, and I think this was 2018, was to do mission and values work for the firm. I mean, 18 years into our existence, we go and do something that startups in the beginning, right? But
yes,
it's never too late, I suppose. But it was sort of a journey to find out who we are and what drives us. So we did the mission and values work, and our mission. I'd love to sort of say this is to invest in positive, powerful change that endures. The way we think about our business today is, well, we want to make positive change. The way you make positive change is by helping build companies that can endure for a long time. And the companies that can endure for a long time are the ones that are in the interest of society. And so you have to think about simultaneously focusing on enhancing purpose and profit. And so when you take a step back on that, and I always like to caveat that I'm a capitalist, I'm not an impact investor. The point is, if you want to build the most compounding businesses and therefore create the most value for your investors, you must think with this long-term mindset. And so today I think of GC as a platform for inclusive capitalism. We want to build these kinds of enduring companies that bring everybody on board and create opportunity for everybody, be inclusive. There's this handful of areas where we think that is really interesting for us to do today. Those areas I wrote this annual letter last year where I articulated that are obviously the geopolitical shift around global resilience, where each nation is thinking about, their climate and defense and food and ag, and how is all that going to work in a way that they can protect and take care of their people. There's the technological shift around AI, which is profound and touches everything. And then, we're very keen on the industry transformations around health assurance, as we call it, and financial inclusion, which really gets done at the intersection of fintech technologies and decentralized crypto technologies, and how does that really manifest a better inclusive economy? So those are the areas, and everything we do is focused on how do we really help the very best founders create those mission-driven companies in these areas. And all of our products are focused on empowering the founders to build those enduring companies. So the innovation that you see, I always tell our LPs this, you should always ask us, how is this reinforcing our core, which is the early stage, the venture firm that we were and continue to be thinking of ourselves at the core, and how does it really help these founders endure for a long time? Those should be our products.
We had Maamoun and Ilya on, and they talked about how Kleiner was doing so much, and then they consolidated, and they're all one fund, one team, one dream, and they're just a generalist firm that, wins Series A deals. We also had Ben Horowitz on, and of course, A16Z has built this massive platform and almost fund to funds where they have different practices and, have massive AUM. And I'm curious, it feels like you're more in the A16Z game, where you think of venture as a product, as a business. You have these different product lines. You yourselves have massive AUM. I'm curious if you think the future is more that way, and how you think about that sort of comparison to begin with.
First of all, when you talk about Maamoun or you talk about Ben Horowitz, these are iconic investors, and what that tells you is there's actually many ways to succeed in this business. And I always remember my conversation with Andy Golden, who runs the Princeton Endowment and has been a lead investor for us forever, where I used to always ask him, well, how do we compete? How do we become a top firm in the ecosystem? This is in our early days. And he would always say, play your own game. And there are many ways to succeed, and just focus on what your game is. I think both of those firms are in a great trajectory. I think they're both very different from us. We think about scaling perhaps a little bit differently because I'm not sure you can scale venture capital funds to be very large and maintain performance. This is what happens. Bubbles happen, people get exuberant, funds get bigger, bubbles collapse, funds get smaller. We're in the middle of that right now. And I think our industry kind of just keeps oscillating in this three-dimensional innovation of state, sector, and geography, and funds around it. We just keep trying to optimize that. And And I think we have to think very differently when you go back to the areas that I mentioned. If you're going to work on climate change, if you're going to work on transformation of the US healthcare system, which we're very deep into, about a dozen years into, if you work on financial inclusion, those are just not problems you can work on with a 8-10 year horizon. So if that's our agenda, then we have to start looking different from sort of a traditional venture capital firm. And that's what's happening to us. And, Ken always says great strategies are built in hindsight. I think ours is too. It's just a set of instincts and considered decisions as we're building this. But I'm very excited to see what we do become in a few years, but it'll be aligned with our values and our mission.
Yeah.
And focus on the transformations I'm talking about.
And what does that mean more concretely in terms of how you guys are structured or organized or sort of plan against that vision?
Yeah, I think a lot about culture. Okay. And the kind of culture required to build the type of firm we're trying to build is one where you preserve the magic of a partnership when it comes to investment decisions, where a few of you debate and discuss and make decisions on a particular investment and then get behind it as a firm to help build that company. But at the same time, you need to run with the rigor of one of those iconic portfolio companies I mentioned earlier, so you can actually endure. So how do you really build a culture that allows for both? And so one of the reasons my title is CEO and Managing Director is when it comes to an investment decision, I'm just another investor around the table. There's areas where I have done well, and so the firm will listen to me more. And there's areas where I don't know much, and the firm should not listen to me. When it comes to building a platform, I run the business, and they're very much a CEO, and we're going to run it with our OKRs and our executive committee and all the things.
Hey, we'll continue our interview in a moment after a word from our sponsors. Even if you think it's a bit overhyped, AI is suddenly everywhere, from self-driving cars to molecular medicine to business efficiency. If it's not in your industry yet, it's coming fast. But AI needs a lot of speed and computing power. So how do you compete without costs spiraling out of control? Time to upgrade to the next generation of the cloud. Oracle Cloud Infrastructure, or OCI. OCI is a blazing fast and secure platform for your infrastructure, database, application development, plus all your AI and machine learning workloads. OCI costs 50% less for compute and 80% less for networking. So you're saving a pile of money. Thousands of businesses have already upgraded to OCI, including Vodafone, Thomson Reuters, and Suno AI. Right now, Oracle is offering to cut your current cloud bill in half if you move to OCI for new US customers with minimum financial commitment. Offer ends March 31st. See if your company qualifies for this special offer at oracle.com/turpentine. That's oracle.com/turpentine. Hey everyone, Eric here. In this environment, founders need to become profitable faster and do more with smaller teams, especially when it comes to engineering. That's why Sean Lenihan started Squad, a specialized global talent firm for top engineers that will seamlessly integrate with your org. Squad offers rigorously vetted top 1% talent that will actually work hard for you every day. Their engineers work in your time zone, follow your processes, and use your tools. Squad has front-end engineers excelling in TypeScript and React and Next.js ready to onboard to your team today. For backend, Squad engineers are experts at Node.js, Python, Java, and a range of other languages and frameworks. While it may cost more than the freelancer on Upwork billing you for 40 hours, but working only 2, Squad offers premium quality at a fraction of the typical cost, without the headache of assessing for skills and culture fit. Squad takes care of sourcing, legal compliance, and local HR for global talent. Increase your velocity without amping up burn. Visit choosesquad.com and mention Turpentine to skip the waitlist. How does macro determine your strategy? We saw Founders Fund pull back significantly on their fund size. I'm curious how macro determines strategy more broadly.
I think if you take the pressure off of we want to make these funds bigger and bigger and bigger and say, we want to be on sort of 3-year cycles and there's a certain amount of capital bottom up that our organization can and should invest while maintaining high performance, sort of sticking to that and sort of saying, hey, venture capital work is your innovation factory for solving those long-term problems. The other question is, what else do you need to be able to then compound these businesses and drive those transformations at scale, which our industry hasn't traditionally thought about, right? We don't think in the context of we're building ecosystems and creating broader change. We think about how do we take a company to a certain amount of scale, take it public and exit and turn it over to other investors. My view is that as the industry institutionalizes and as the type of work we do ends up being much more sort of societal and in terms of efficacy of core pillars of society versus just efficiency with software, we need to think differently. We need to think on a longer horizon. We need to think about our governance in a different way, which is why we've done a lot of work on responsible innovation. My last book was focused on trying to frame the mindset and mechanisms for that. And, we need to have a capital base and a set of tools that can help these founders and companies through those inflection points for that longer change. So that's what drives the way we think about our firm, the way we think about the people we have in the firm. I mean, this is a very eclectic place. We've got 2 Fortune 500 CEOs. We've got a filmmaker who's won a couple Oscars. We've got one of the most elite bankers in tech and some trade investors. It's just eclectic. And I think it unlocks that diversity of thought so that founders can work with us, on that long horizon.
When you look out at the future of VC and how the asset class is evolving, do you think that more firms will be doing kind of some of the financial innovation that you guys are doing, or some of the product innovation, or how do you think about the future of how the asset class is evolving?
I said this, I want to say like 6 or 7 years ago now, that as the companies are starting to stay private longer, some should and most shouldn't, but as some were, it was very clear that some of us who were focused on early stage were growing up to figure out how to help those companies endure and maximize their opportunity in them. And then you were also seeing some of the public market investors coming in, commoditizing capital and essentially flooding it into the system to say, let's just buy the options, and the ones that work will in the end work out because of power law, right? And my belief was you'll see a few of us grow up to be sort of interesting, unique platforms, and you'll see a few of them come down and actually learn how to do the early stage part of the business and become full stack platforms. It's worked well for some, not for others. I think it's about the difference is going to be which ones have taken the time to invest in culture and create a sense of purpose and mission for why you're doing this, and which ones have just been mercenary. And that's ultimately what determines missionary companies become category defining companies. And I think there are, a handful of firms that are doing it that way. And I think they'll become enduring large platforms, and others will struggle. But we'll always have the long tail of early stage firms as well. The opportunity is so large, like so many different sectors are firing on all cylinders. We're not even done with the previous cycle, and now you got the AI inflection happening to everything. That the solopreneurs, folks like Elon, I think they are franchises. I think there's a bunch of early stage firms that are going to have continue to have a great future. And then you'll see some platforms, right, that want to have many, many different ways to engage with the founders, that are thinking over the long term.
I want to return to something we discussed earlier about your responsible innovation thesis, just the desire to do good. I've heard one critique of the clean tech era, the critique being that the investors were too inspired by the idea of doing good, that they weren't rigorous enough in their kind of underwriting of these opportunities. They wanted it so bad to be true. I'm curious if you agree with that assessment, and then also how you or people in general should think about balancing the desire to see a certain reality come to pass with also just being realistic about what's the real opportunity.
First of all, having been one of the people that failed a ton in clean tech, I can give you many critiques of the clean tech period if you'd like.
Please.
At some point.
Yeah, let's hear it.
But no, I won't go there now. But I think the core issue when we were doing 1.0 was the playbook for how to build a company wasn't sound financially. The policy designs weren't sound to create, reliable markets, which made the capital unreliable. And these companies need long duration to succeed. I think one of the big things about responsible innovation is to not think of this as you're somehow trying to optimize diametrically opposed metrics around purpose and profit. I think you have to believe that by being purposeful, you will actually enhance your profit. And so I think the clean tech 1.0, those markets just weren't set up, and we didn't build the companies the right way, is a reason that they failed, and the economics weren't just thought through. I don't think it's because they were just do-gooders saying, we'll take less margin. We just never made a viable business. in most of those cases. And it was only forces of nature like Elon that got through because they just brute forced it. But very few companies got to that scale. So I wouldn't overthink that there are mislearnings around responsible innovation from there. I think in this next phase, especially in the areas that I just mentioned, how can you build a company that's going to be around for 30 years and be an amazing investment if you don't embrace responsible innovation? How is that possible? And I think that's my personal hope, is that our firm just proves that that mindset is a way to create elite returns. And, we're very much on that journey.
That's well put. From a firm strategy perspective, how do you think you're different than A16Z? Because I see a lot of overlap in the ambition. Or how do you guys think you do things differently?
I mean, I love listening to almost everybody there because I find them really provocative in the way to think about the world. In terms of how are we different, probably responsible innovation is something we lean into a lot, and I'm not sure that's like an explicit strategy. I would say we're not really doing, other than healthcare, not really doing sector specific funds. So I think our product construction is probably different. We have this customer value fund, and our funds are going to be smaller. I don't think we're going to be scaling to the size that I've seen them scale. I just, at least for us, I don't know how to generate elite returns on very large fund sizes. So we're going to be on a more measured sort of venture capital complex. I think we have a different approach in healthcare. We're focused more on health assurance. They're more focused on life sciences and AI.
Let's talk about healthcare, because you guys have done phenomenally there, and you in particular. What is your unfair advantage in healthcare, and why have you guys done so well?
I think first of all, we got lucky that when we built Livongo, there were a set of instincts around what became the core pillars of health assurance. We ended up partnering with Glenn and Lee, there's phenomenal entrepreneurs in the space. And we were able to create a culture that was truly tech and healthcare at the beginning, which was our thesis when we founded the business together. We bought a little company and we launched in like 2014, I think. So first thing is that we were fortunate enough to be part of a ride that showed us how to build a good company in the space that had, good economics, good margins, then you had like 100 companies that showed up that were Livongo for X. That's when you've built a category defining company that it unlocks a lot of opportunity around certain mechanisms. In 2019, because we had about 15 or so businesses, I already had launched Commure as one of our hatches and a few others. I had given a presentation to a partnership in that fall, and I was writing my book on healthcare, that next decade is going to be about healthcare, and we should lean in. And we should make it be a 20% bet for us. And I'd like us to become very intentional about it. And this was pre-COVID, right? And talk about perish the thought, but talk about getting lucky in terms of having a prepared mind, and then COVID happened to you, where that's like the iPhone moment of the space. We just said we must lean in. We must turn this crisis into an opportunity, because we had a thesis, we had a track record, health systems were asking us for help, and our philosophy was all around radical collaboration with them. So it just became what better time to lean in and make a difference. Set of lucky circumstances that over time manifest themselves into an unfair advantage, perhaps. But I'll tell you, we have a lot of work to do. We have a lot of companies and great ambition around achieving the health assurance vision. But I mean, I look at the amount of work that needs to be done. It's like it's easily 15 plus years from here. So we'll see how we actually turn that unfair advantage into real value returns. But I'm very optimistic. I'm very excited about it.
Yeah. And how do you think your strategy is differentiated from all the other healthcare funds out there in terms of the way that you're thinking about it?
So one of the things we've really heavily invested in is developing partnerships with a lot of health systems. So our belief is that if you truly want to make this industry proactive, reduce the healthcare GDP, and solve for health equity, which are sort of the three pillars of health assurance, you have to help our provider groups, health systems, become better businesses. They need to become vibrant. They need to have 20% EBITDA so they can invest in their communities and have a flywheel of profit to accomplish their purpose. Going back to my point about alignment of purpose and profit. And so we're doing everything with the mindset of how do we drive that theory of change. And so I think having that sense of mission, and then so many founders have come and wanted to work with us because they agree with that and they want to be part of enabling that, then over time that just becomes an ecosystem. And I've said before, the Amazon of healthcare is not a $1 trillion company; it's a $1 trillion ecosystem. My hope is that the founders we're working with collectively can come together and help implement that theory of change.
Totally. Let's talk about your incubation strategy more broadly, and you guys call it creation. When you talk about how you've developed the strategy, how you think about it, and how you think about it maybe differently than others in the industry.
So creation for 20 years has been highly serendipitous. And I think it happens because you just had a bunch of investors that were builders in their previous mindset. I was an entrepreneur. Joel and David were entrepreneurs. Larry was running tech companies. And so, I would say the three most interesting historical incubations for us were Kayak, which we started in 2004, Demandware, which became the Salesforce Commerce Cloud, and Livongo, digital health. So like three different category defining companies. But it was all serendipitous. And I think what we're doing now is thinking about, well, what are the types of projects that kind of naturally wouldn't self-combust in our ecosystem, where we can maybe catalyze interdisciplinary teams. They're capital intense. They need access to certain parts of the networks to make those markets develop a certain way. Those end up being good projects because we want to be net accretive to the ecosystem in the way we do our work. And we have a new partner who just joined, Mark Bhargava, who's helping us, bring more structure to how we align with potential co-founders for those efforts, and how do we get better at research and rigor around the ideas we choose to work on, so that maybe instead of doing one or two of these a year, maybe we aspire to maybe do 6, 7, 8 of these a year. We don't want to turn it into a factory because every category defining company has its own culture. So starting with a factory would just not lead to the outcome you're hoping for, which is building category defining companies. So we really want it to be that we're this invisible co-founder to folks in solving big problems with our creation efforts.
I want to also go to one of your other strategies. You mentioned the customer value strategy. Why don't you unpack what exactly you're doing there? What inspired it?
For subscription-oriented businesses, when you think about the CAC LTV equation, it starts to become a little bit like a digital project finance opportunity. And the observation was so much of the equity gets invested in, funding sales and marketing. You could literally think about that as financing, your CAC with a certain IRR threshold effectively. And so, we came up with a way to finance that in a way that isn't equity oriented. It's not diluted to founders. So that's a better product to figure out your growth once you have a convicted product market fit in the business, then continue to pour equity and keep diluting yourself. So we thought it would be an interesting way to support our founders and frankly our own investment in their companies to go much longer and compound much further by giving them a facility like that. That strategy has been off to a great start. We just did our first public company investment out of that in Lemonade as well. And so I'm excited about that being just a really founder-friendly product that we were able to create for high-growth companies.
What are firm products that don't exist yet that you want to launch in the future?
I don't think that way. I will reframe it into what are the problems we want to work on that we maybe aren't well suited to, and then the products will come to us.
Yes.
And so I literally couldn't tell you that here's a next fund we want to create, but how we're going to work on climate change, right? The energy transition, that is such a complex problem when you think about how you build those companies and finance them. And it's not just about solving the technology problem. It's actually about delivering those solutions at scale to really matter, right? That should be our end goal. So like, how are we really going to do that? And you certainly can't do that in a sort of 10-year horizon. So what is that going to look like? So I think we think about examples of things like that. Well, rather than, okay, what's in the next fund we can go create? So, if you think about the AI transformations that the industry needs, which I think AI is going to be much more about transformation of existing industries than just innovation, because every business in every part of the economy is thinking about how to use it all at the same time. It's an amazing transformation opportunity. And so, like, how do we really serve those companies? What does that really look like? So being flexible in how we think about capital and governance to solve these problems versus we're like a hammer looking for a nail with a 10-year fund with, fees and carry is probably the departure we've had from the existing way of thinking about the industry. And, I'm sure we will innovate in the future. I can't tell you what that is, but I'm sure there'll be, more innovations that come our way in the next few years.
Talk about your global resilience practice.
If you think about what happened in the last few years, you think about Ukraine and the energy dynamics it created in Europe. You look at COVID and the vaccine dynamics. You think about SWIFT and kicking Russia out. All of a sudden, a lot of the things that countries took for granted in the globalization era, they're not going to just assume those things are there for them. So I think sovereign nations are going to want to take care of their own people for the core basic needs in a much more programmatic way, which, by the way, is going to cause structural inflation in the system as well. And so what that does is it makes you think about opportunities differently. In the traditional venture mindset, you're just like, that stuff is so macro, it doesn't really matter. We're just building little companies down here. But I think when you think about, industries like defense, where we're investors in Anduril and Vanavar, or you think about, again, the pandemic vaccine response, things like that, you're going to have to think about these things. Or even if you look at AI, look at what's happening. European nations are all saying we need our own AI because we don't want to rely on the United States. And so can you build these technologies in ways that you do give each of the nations resilience in the core areas that they care about? And how does that change how you think about business building? So that's a lot of what's driving our global resilience thesis that Paul Kwon is really the architect of, and has done a wonderful job, helping us sort of build a portfolio around.
I want to go back to healthcare, because some people lament. They say, hey, there's been so few transformational outcomes the past couple decades in healthcare, and we expected to have all of these decacorns in digital health. You're perhaps one of the only ones, or the very few. Why has that been the case? And why is the next decade going to be different?
So that has been the case because the way the system works, where who pays and who benefits and who decides are all different people, it's like a fundamentally misaligned system. So you innovate, but those innovations then just get acquired to be incremental inside of the bigger platform. So that's the nature of what has happened in this industry. And one of the things I was excited about when we combined Livongo and Teladoc was that maybe we could actually build a provider-centric platform that was digital and was going to be scaled enough to create more balance in the power dynamics in that industry. Didn't happen. Look, we're trying to see that we can help change it, first of all. And the only way it's going to happen is if we actually build this ecosystem that's buoyant together in creating some of the structural changes around aligning the interests. So can the providers take risk? They're all trying to figure out how to do that, but that's a really difficult transition. Can you move to value-based care? No one company can solve this, right? And so, can you actually have an ecosystem trying to do that in concert with each other? And if you could break through that transformation, then this is 20% of the GDP. You are going to see multiple decacorns. And I think that's the bet we're making, that over the next 10 years, we can get, and I said this in my book, that maybe there's 10 to 15 platforms that do get built that are large and represent the next generation of the health assurance ecosystem. We'll see.
And say more about for all the operators listening in who might want to build something healthcare. Where do you see as the opportunity or white space, or what's your request for startups?
Look, I think because COVID was such a jolt to the system, there's a lot of companies that have been started that are actually quite interesting. There's a lot of innovation that is underway. Of course, there are more ideas around value-based care. I think the use of AI into this industry in a thoughtful way is very interesting. We just launched this business, Hippocratic AI, in partnership with the folks at A16Z and the founders. And their dream is that you solve the workforce shortage issue here and just make it abundant with AI, so you can actually serve people in a much deeper way. That'll make a difference, right? So I think there are a lot of things around how AI gets embedded to rethink some of this. I think the idea of what are the pieces required to move to value-based care is important. And I'm talking about the healthcare delivery side. I'm not talking about the life sciences side, which is obviously its own beast, and we have a increasing amount of body of work in that area as well. And you know, but like my focus right now is there's a lot of companies, a lot of founders that have jumped in. We need to help them scale and break through this barrier. So like, how do we get, we probably have over 100 companies in this space in our portfolio. Like, can we help them, as many of them as possible, to get to that scale so we can break through, and I'm very, very keen on seeing the maturation of this, the innovation ecosystem that just got created on this area with like very, very smart founders, very mission-driven founders over the last 3 years.
As a thought experiment, it turns out that you rose up and became CEO of General Catalyst, but let's say that wasn't an opportunity and you had to go out on your own in 2023 and start a new aspirational franchise, like many listeners of this podcast are trying to do. Where do you think is the opportunity for emerging managers in 2023 who have big dreams, big ambitions? How would you approach it differently, or what advice might you give them?
First of all, I think I've said this a handful of times this year, that thank God we moved there in 2011 and not 2023. You think about like what the opportunity was and, what happened with the App Store movement and stuff. We just got really lucky. Timing has a lot to do with, you can work really hard, but timing has to be on your side. And we got really lucky when we moved here and started building our West Coast presence. I would say, if you do it today, you have to do it with a point of view. Because you have to rise above the noise. The capital is so abundant. This industry is overcapitalized, no matter how you look at it. And so you have to work with what's your value proposition to the founders. And so, like what Sarah's done with AI, work that she's doing, and it's just having like a deep point of view with which you want to engage with founders early on is what it's going to take if you want to build a business today. I think we're generalists. It's kind of the way I grew up, and we do a little bit of everything. It's just very plain vanilla, and it doesn't work. I think everybody's got great network, everybody's got capital. It's like this 20-year journey in venture capital to say my money's greener than yours. I think that game's over, and so you better have real value add if you want to rise above the noise and build an enduring firm, sort of starting today.
Gearing towards closing here, I want to end with a couple questions. One is, how do you think about talent, right? They're just like any great big firm, there are a number of people who've risen up, a number of people and who are still here today, a number of people who've left to start their own practices. And you had some great alumni at GC. And then also you've brought in some great people. You mentioned Mark Bragava. There's a number of them. What is your approach at GC to talent, to cultivation, retention?
Yeah, I think, first of all, if GC is going to be an enduring firm, it's because we figure out a way to develop next generation franchise players at the firm. That it just has to be. And in our philosophy, going back to the diversity of thought, is that we don't have a GC way of investing that we want to teach everybody. We just want to weaponize you to create the change that you want to do in the world. So if you have a thesis like that, come talk to us so that we can turn you into a platform. So I think that's one thing, is can we activate more Paul Kwans and Mark Bargavas, as we discussed, or Chris Bischoffs, to be like, gee, I want to go work on the following transformation, or Elena was doing in the life sciences, and give me the platform to do that and get behind us, right? The philosophy over the last few years, we brought in some very senior people, was to invoke that diversity of thought, but with people that share our values. So everyone that we brought on, we had multi-year relationships with, and that alignment around mission and values was just, if you ask any of them, that's why they came here. They came here because of responsible innovation. They came here because they know we're trying to build a long-term business. They came here because we're thinking about these things at scale. So I think, but that was a short-term hack. If we were to seize the moment and get to some reasonable amount of scale to drive these industry changes that we want to do with innovation, we had to bring that talent in. When I think about the next phase, so much of it is about, cultivating the next generation talent. So we're constantly looking for that. And if we see people that are mission aligned, we'll create roles for them if we think they can come and do really interesting work here.
Yeah. Totally. That's an inspiring note. And you have some amazing people at GC. How do you think GC kind of situates in the ecosystem, right? We have, we interview people from Sequoia, from a Benchmark, from Kleiner, from Andreessen, the founders or the leaders of these firms. We have a separate podcast, LP podcast. And so we talk to a lot of LPs as well. And then how do you think about where General Catalyst fits into the venture ecosystem in terms of like, how should we think about it relative to these other firms in terms of where it really separates itself and where it really spikes?
Look, I always feel like we have a lot to learn from all those firms. Some of them as individuals, like Mark and others, that are just historians of technology and help shape it. And some of the firms that have been around for a lot longer. So I view us as an upstart still, even though we've been around for 20 years. I genuinely do. I think we're constantly trying to learn and innovate. So in that sense, even LPs look at us, they probably see a much more dynamic place, probably just like A16Z in some ways, as you said earlier. But we're probably more in the use technology to radically collaborate versus use technology to disrupt camp. That's probably one place where we philosophically tend to be a little different. But again, as I said, like there's so many ways to succeed, and all those firms have just been legendary in what they've accomplished. And so, even to be mentioned in that group, it's a privilege and an honor. But we have a long way to go. I genuinely feel like we're just getting started. I feel like we finally have a shot at doing something interesting.
Totally. That's an inspiring note to wrap on. So I might wrap on that, but let me just pull this one thread. You mentioned, and we alluded to in this conversation, and you wrote a whole book on it, the sort of, instead of hardcore disrupt, more around invent to collaborate. Pull that thread a little bit. Talk more about what that looks like concretely, or what's an example of that.
I mean, look, radical collaboration is how you're going to create great change. That's the bottom line. If the mindset is, how do I build a company that can get to $100 million in revenue, go public, get a great multiple, and I exit? Let's say it's in education. Great. Be disruptive, and you'll do that. If the mindset is you want to change the education system, well, you're not going to do that, but as a single company with that complex a role. Probably, unless you are, somebody like Elon, who's literally moved the entire auto industry towards, a theory of change. I would say, in most cases, you need to engage with the ecosystem, and you need to learn from them as to why things are the way they are, and what was the spirit of the policies that were there, for example, as opposed to just poo-pooing what exists today because we're so much smarter than everybody. I think there were lots of really smart people whose legacies represent the enduring organizations, and a legacy is a great word. When we say legacy industries, we think of that as a tarnished word of like, oh, they're old and stodgy. But no, they made a big difference in society. And so, can we figure out a way to innovate fast and work with them so that we can scale that innovation fast? Is the essence of why we're leaning into radical collaboration so much.
Hemant, that's a great note to end on. This has been a fascinating conversation. Thanks so much for coming on. For people who want to learn more about your mission and your work, where can you point them?
Come to our website. Jennifer would be happy. I think we would have put a lot of thought into articulating our philosophy and how we're approaching things and our values. So, come or email any of us. We're all accessible, and come talk to us.
Great. Thanks so much for coming on, Hemant. This has been a great episode.
Wonderful. Thanks for having me.
Turpentine VC is a podcast from Turpentine, the network behind Moment of Zen and Econ 102. If you liked the episode, please leave a review in the Apple Store or rate us on Spotify. Hey everyone, Eric here. At Turpentine, we're building the first media outlet for tech people by tech people. We're the network behind the show you're listening to right now. We have a slate of hit shows across a range of topics and industries, from our AI and investing cluster of podcasts to shows that drive the conversation in tech with the most interesting thinkers, founders, investors, and influencers, like Econ 102 with Noah Smith. We're launching new shows every week, and we're looking for industry-leading sponsors. If you think that might be you and your company, email me at eric@turpentine.co. That's ERIK at turpentine.co, and let's partner together.